Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 27th of March. The US dollar opened with a negative gap against its major counterparts today after the House vote regarding Trump's healthcare bill was cancelled on Friday. The Republican leaders decided to withdraw the bill altogether rather than suffer a defeat in the voting process, as they lacked the necessary votes to pass it. Even though President Trump and the Republican leadership quickly reassured investors that they will now concentrate on introducing big tax cuts, the inability of the new administration to deliver on health care may have raised concerns that tax reform is likely to encounter similar obstacles. What's more, reforming healthcare was one of the conditions for making the tax numbers Trump pledged feasible. As such, hate and doubts over Trump's ability to deliver on his tax promises could keep sentiment among investors somewhat subdued and thereby weigh further on the greenback. Asian and European equity indices felt the heat as well, opening with bearish gaps. This negative sentiment may roll over into the US markets, where we expect stock indices to open in a similar fashion. Dollar-yen gap down and continued to drift lower during the Asian morning Monday, falling below the support now turned into resistance barrier of 110.70. Following the dip below 111.60, the lower bound of the sideways range that contained the price action from the 11th of January until last Wednesday, we believe that the outlook has turned negative. Therefore, we expect the pair to continue trading south and perhaps challenge the round figure of 110 sometime soon. If the bears prove strong enough to overcome that psychological zone, then we may experience extensions towards our next support obstacle of 108.80, defined by the low of the 17th of November. Now back to Eurozone. The bloc's economic growth hit a 6-year high in March, according to the bloc's preliminary composite PMI survey that was released on Friday. The PMI index beat its forecast for a marginal decline and instead rose further, while the report was upbeat in all economic fronts. The euro started strengthening ahead of the report, boosted by the German and French indices released a few minutes earlier, and continued drifting north in the aftermath of the block's print. Considering the strength of this forward-looking data, we could see the common currency enjoy increased demand in the next days or weeks, on speculation that the ECB could start to reduce its stimulus dose perhaps as early as next year. Euro-dollar opened with a positive gap on Monday after the defeat of President Trump's healthcare package on Friday. After clearing the 108 key resistance now turned into support territory, the pair broke above the 108.25 barrier, and during the early European morning Monday it looks ready to challenge the longer-term downtrend line taken from the peak of the 3rd of May and the resistance hurdle of 108.75 marked by the high of the 8th of December. A decisive break above that key crossroad could solidify the completion of an inverted head and shoulders signaled upon the breach of the 108 territory, and is possible to confirm a medium-term trend reversal. As for today's highlights, during the European day we get Germany's IFO survey for March. The forecast is for the expectations index to have risen somewhat, while the current conditions figure is expected to have ticked down. We see the risks surrounding the current conditions forecast as skewed to the upside, perhaps for an increase instead of a marginal fall. We base our view on the ZEW and PMI surveys for the month, both of which showed increased optimism in the German economy. In case of a positive surprise, the euro could extend its recent gains, as this would be another set of numbers entering the basket of data that support a gradual end to the ECB's stimulus program. As for the rest of the week, on Tuesday the economic calendar is light. The only event that is likely to attract some market attention is a speech by Fed Chair Yellen. On Wednesday, the main event will be in the UK, where Prime Minister May is expected to trigger Article 50 of the Lisbon Treaty and commence the formal process for leaving the EU. We do not expect the actual triggering to be a particularly big market mover for sterling, as the move and timing have been signaled repeatedly over the past months and weeks. On Thursday, we get Germany's preliminary CPI figures for March, and from the US, the final estimate of Q4 GDP. On Friday, during the Asian morning, Japan's CPI data for February are due to be released. In Eurozone, preliminary CPI data for March are coming out, and in the UK, the final estimate of Q4 GDP will be in focus. From the US, we get personal income and spending data for February, as well as the core PCE price index for February. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.